hopefully we're on the same question.
Are we? Are we on the same question?
Well, we've definitely got the same piece of paper.
Okay, yeah.
We should have gone to Specsavers.
Great, okay.
Yeah,
sorry, I haven't got my glasses.
I'm just trying to keep you on your feet,
Yeah.
Chris. I'm just trying to keep you on your feet, mate.
Has anyone heard of family investment companies?
FICs.
Okay. So let's assume that you've got kids that are going to university, and let's assume you've got 3, and let's assume you pay maintenance for them, you give them some money, and let's assume it's 10 grand each, so that gives you 30 grand a year, just for the sake of argument. Now, if I am a benevolent dad, and if I was a high rate taxpayer, I'm incurring tax at 45%, let's assume I'm self-employed, I've got 2% NI, 47% tax is the rate I'm paying, tax plus NI. So broadly speaking, for me to give them 100 quid, I've got to earn 200 quid, because broadly I'm going to pay 50% in tax. And because I'm a 45% taxpayer and I want to give them 30 grand a year, I've got to earn 60 grand before tax. Now then you'd say, well actually, if I am self-employed, could I just set up a limited company, a family investment company? And if I did that, if I can get income into that company for my services, and they were a shareholder of that company, they could take a dividend out of that company, and if they were at university and didn't have any income, you could probably go up to dividends of 50 grand each, and they probably wouldn't even pay 5 grand in tax. Because the first £12,570 is tax-free, and they're not utilising that, so they have a personal allowance, as does everyone in this room, on the assumption you don't earn more than £125,000, 140. And then, so you can keep your personal allowance. But what if they got the money direct from the company? It doesn't come through me. If it comes through me, I'm paying 47% tax on that money. If it goes direct to them, the income's in your family investment company, which is, with that gentleman, broadly people are using FICs and or trusts. And this is like another alternative. And you can seed income into that. And what you're doing is you've just got to be a bit cleverer in how you structure your affairs. And if you look at it, a bit like this farmer client that came to us, he hadn't actually known there was losses in that business. And that's sort of how we come across, and then we can utilise those losses. So in this scenario, if you set up a different structure, that structure you could use for maximum tax benefit. So in this case, they don't, just because you've got 3 kids and there's me, for the sake of argument, they don't have to have 25% of the company. You can set up different share structures, different rights, just have to have a right to dividend. And that dividend right could be a different class of share from my share. But it's a way of seeding them with money, and you've got to sort of think laterally with the same things with capital gains and the same with inheritance tax. And the capital taxes are things that are really going to come and bite you on the bum at the moment because of the way the legislation is. And you only have to look at, I'm talking about business property relief, it's now called business relief, but look at the farmers, that's agricultural property relief, that's the inheritance tax, that's the inheritance tax that's going to hit them. And that's the issues. And if you've got a business, I could have sold my business for umpteen million and it would have been free under business relief. Now there's going to be a limit from the 5th of April next year of £1 million, the same as farmers. Agricultural property relief is £1 million. So you've got to make sure you structure your business, and these aren't transferable reliefs. So inheritance tax exemption of 325, if I die today and I leave everything to my wife, she gets my 325 inheritance tax exemption, which means she gets the first 650 tax-free. There might be residence nil rate ban to claim as well, but it depends on the value of the house and whose the house is left to. But what you've got is that this business relief isn't transferable. So you've got to change the structure of your business to make sure that other people can benefit from the business relief. And to do that, you've got to give them a stake in the business. And then so when you do this tax planning, you've got this tax plan, you can go back, we're doing tax planning perhaps 7 years in advance. A potentially exempt transfer, I make a gift to someone, that's a 7-year tax planning. If I want to claim BADR, business asset disposal relief, which is where I reduce my capital gain, that capital gain, to do that, I've got to be eligible for the 2 years prior to the sale. So a lot of this stuff is that you can't just wake up tomorrow and say, I'm going to claim that, because you've got to have all your ducks in a row before it. That was a bit of a mouthful.
Did you write that down?
I'm justify setting up a family investment company? How does it? It's got to earn some income then somehow or other. You can't just shove money into it.
No, but I mean, say I do consultancy work. So I've got my limited company. What if I set up another company and I do my consultancy work through that company? What's wrong with that? Just because that company has different shareholders, it doesn't always have to come to me. I mean, I don't have to work 50 hours a week in that company. I could work 20 hours in that one and 30 in that one. And if that 20 hours produces the income that gives the dividends for the kids, well, that's what I've done. Yes, Paul?
I think it's right in saying that if you set up a family investment company, it's only effective from now on or from when you set it up. So if you're going to do it, you need to do it sooner rather than later to crystallise.
Yeah, you can't backdate it. I mean, if I set up a company, it's only going to start from the date of incorporation. But you've got to be planning for this stuff, and then you've got to make sure you can get an income stream to go through the company. And that assumes you've got different income streams and you can take advantage of it. But it's a bit like this farmer. I mean, he's got some different businesses, and I said, look, you've got consultancy income. You don't have to do the consultancy income from that company that's making all the profits. How about you do some consultancy income from this business that's making the loss? We put income in it, which will soak up all the losses. But no one had explained that to him, and he didn't even know the losses were there. And it's sort of easy pickings if you look at it, but it's just a case of sometimes people don't know what they're looking at, and that's all what you're doing to help them out. Yes, sir.
So what if we already have our limited company running for a certain amount that already has assets, as in, for example, cars in it? Are those assets then transferable to the new company, to the LLP?
Well, you've got to be slightly careful, because what happens is your present company will have a market value. And so if you give shares today, then depending on it's trading company or not, you might crystallise a capital gain. Okay, so then you might crystallise a capital gain, because you can't claim some of the other reliefs that you could with a trading company.
It's not publicly traded, if that's what you mean.
No, it's not what I mean. A trading company is one that is eligible for a restriction on capital gains. You can claim a holdover relief. So what I'm saying is that if you've got a factory that makes widgets, that's a trading company.
Yeah.
If I've got passive income, so let's say my limited company owns rental properties, then if that isn't a trading company, then you can't claim that relief.